Today's video is about perception versus perspective. I'm going to go through a handful of discussions that we had on the Platinum Channel Friday call about swing trading and the week in review, but I want you to put your mind in the state of the enemy. And that enemy is the person that you're buying and selling against. This is about trading. This is about investing. This is about economics. This is about relationships and human behavior. And if you can change your perspective on what is truly happening, you will become a better investor. So let's start with Mark reviewing the indices and the 2-week sideways movement that the S&P, the NASDAQ, and the Dow Jones Industrial Average have been in for the last, 9 days or so. And take the perspective of what they are doing, what the institutional traders are doing, and how they are thinking, and most importantly, how they make money.
Got some charts on Trent kind of alluded into the sideways motion of our indices, and here's SPY, which is the S&P 500. This is tradable. You can see, during November we saw the big uptick, and then all of a sudden we hit. This is November 21st, and we've been going sideways ever since. You can see here's our intermediate resistance line, and as these lines squeeze your price action between resistance and support at the 9, it's going to pop out one way or the other. And even down here, you look at your MACDs are flat. Okay, they're undecided. It's a slight downward turn of the MACD. They're just waiting to either go up or to go down. And that's where we have been for the last couple of weeks. And the same thing is true for the Qs. You can see there's almost the same chart. Okay, stepped up, boom, sideways. And part of that is because you go back and you look into sectors, and I go and try to find the stocks to trade. So I'll go in and look at sectors of like the S&P. And here's your industrial sector. So it came up, it was sideways, popped up, and then here we are again. It's hitting and trending along the intermediate resistance line. Then we go to the financials. Same thing. We've come up, we've hit the intermediate resistance line. I mean, so it's, and again, the 9s are coming up and they're squeezing our price action between them. And this is why it's been hard to kind of find good setups like we have back here, where you cross over and it moves up. Now we're sideways. So I can't tell you which way it's going to go. I can go down and look at our indicators, say, okay, the MACD is, flat. We got a stochastic is flat. We got an RSI that technically people would say is oversold, but it's just at the top level and it's going to stay there. So we're under a situation where the market is just trying to figure things out. XLV, let's go look at healthcare. Same thing. Okay, we come up sideways. But then, you can look at the other side. And these are where our setups will come from at some point. Energy. Energy is on the opposite end, heading down. You can see our MACD, stochastic. So we'll be watching these for future setups, but they're not there yet. Okay, we can go into the energy, and the biggest one is ExxonMobil. And there you go, ExxonMobil. It's come down. Look at it. It's hitting support, intermediate support for the last 2 days. And now it's come back up to its lower Bollinger. We'll have to see. But these are where I look for our future trades at some point, on the indices and the stocks within them that are looking bad. But for the most part, everything is up on the intermediate resistance line. So, it's tougher to find these things when you're trading sideways like that.
So in this next segment, market goes over the 200-day, below 200-day moving average list that is provided with your subscription to Platinum, the Platinum channel at Best of U.S. Investors. It's not just swing trading, but it's also Kerry's cheat sheet, which is more of a longer-term investment approach, access to Kerry's investment portfolio, his buys, sells, the Friday Platinum call, swing trading call, and Kerry's Friday meetup call that he does as well, along with the ETF tracker, along with the dividend tracker that we've developed, along with everything else we developed, and it's only $60 a month. So you should subscribe. But let's check out what Mark's review of the below 200-day moving average list and get into that. Here we go.
And normally these, I don't really trade like every day. I'll look and see where it hits support or resistance. I give support and resistance every morning where it's at. The yellow ones are the ones that tapped out. You can see this week we did pretty well. Right now they're up about $1,000 on all the stocks, so up about 10.33 a share. We had some really good ones this week. We had the IT or TLT, which is the 20-year bond. Merck did well for us, and also we had Cummings. You see some losses, and you're going to have losses. When you get dealt a hand in poker, you're going to lose some hands, you know. But what you want to do is get out of these things when they're small, okay, within what our oscillators and our moving averages say, and then ride the ones up that'll give us the most profit. And so who cares about these losses? It's if the end goal is, what we're seeing here, which is, our gains.
In this next segment, Mark gets into a question from Paul about trailing stop losses, limit orders, and a couple other different types of orders. So let's check that out, because this is really important, because protecting your downside is the most important thing. The upside to return will take care of itself, but losing money, well, that ain't cool.
During the week, I found it very interesting when you mentioned the sell trailing limit. And what I've been using is the 2%. Yeah.
Stop loss, trailing stop
And
loss.
some of those stocks, as you mentioned, are still running up, like even Fold,
Yep.
or you mentioned TLT.
Yep.
Is that something that you use as a tool for stocks that are running up, or do you have another choice or other options, or is that your go-to? Because right now I've been using the 2% rule, but I'm missing the upside, and I'm like, all the oscillators are good. Why am I selling this? Probably shouldn't.
Well,
See, it has room.
again,
Yeah.
I'm more conservative, so I don't sit every day and look at these. So I'll come in the morning and look. If I'm in a position, I'll set a limit order on the low side. Like here's TLT. Okay, can you guys see this?
Yeah.
So this is the cost basis right here, where we got in right about here. And you can see TLT went up above the Bollinger, hit the Bollinger yesterday. Today it's down because the yields have changed, but I'm still above my cost basis. Now you might have put a trailing off there, and this might have come down and triggered it, and you'd be out today, which is okay because you're still above your profit. I'm looking at it the way I look at trading is how much of this do I want to give back into the market. And so I look at, here's the 9. The 9's above my cost basis. The 20 is above my cost basis. So do I want to put in a limit order to sell at the 9 or a little below? Potentially. I haven't done that yet. But I'm looking down here and I'm seeing a little bit of a rollover. The R side, we're still above 50. I'm looking at the stochastic now. It rolled over a little bit, but we're still up at the 90 level, and it does roll over a little bit. So that's not enough to scare me out of this either, Paul. So it depends on what you want to lose or gain.
Years ago, I had a discussion with a friend of mine who traded for a small hedge fund. It was about $100 million hedge fund, which in the hedge fund world isn't all that big. But what he gave me insight to was how they go about making decisions on when to buy and when to sell, and when to identify pivots in a stock movement. And that is the next segment here, where we talk about bid-ask spreads.
Hey, Mark.
Yeah.
Hey,
Yeah.
Mark. Can you
Yep.
speak to the spread between bid and ask? You mentioned something just a second ago about pre-market, that the bid and ask spread is just super wide, and you can't really look at individual stocks in most cases, like especially these size companies, where in pre-market you'll have a big bid-ask spread, and sometimes that can be very telling, especially during market conditions.
Right. So that's why we look at volume. and we typically want stock we trade in to have high volume, anything over 500,000 to 750,000 shares per day on average. Because if there's not volume and it's thinly traded stock is what they call it, you could find a stock that maybe only, the chart looks great, but it only trades 20,000 shares a day. And then you're like, wow. And then you go look at the bid versus the ask before you put in a buy, and your bid's at $20 and your ask is at $30. That's the difference of a thinly traded stock. There's no market there. Okay. And that's what we want. Like here in Cummings, 1.3 million. Here is 839,000, 1 million shares. So we have enough volume that we have a bid and an ask that is, let's say, we're at 230.33 was the last sale. The bid's probably 230.33 and the ask is probably 230.34. So that's why we don't trade thinly traded stocks. It's harder to get in and out, and you can really get messed up. And
I think I had a trader friend who traded for a hedge fund years ago, and he said we would look for change. He was a day trader, so he's trading, quite a few trades a day. But he would they would follow that bid ask as one of their indicators. And when they saw that spread open up pretty wide, the ask sort of fall out, on the bottom side, he said we could at that point anticipated a pivot in the stock. Now their pivots were anywhere from, a couple pennies to, a quarter in movement, but it's also a very telling indicator as you advance in your trading, is watching that bid ask movement, even on a day-to-day basis. In comparison, when you start to see higher highs and higher lows, you see momentum higher versus higher or lower highs and lower lows, you see, potential momentum change to the south.
And finally, in this segment, I talk about the perception that we as investors have versus the perspective of who we are actually trading against. I believe this is important because if you can change your mindset about who you're investing with or against, and you can look from their point of view instead of your grandiose point of view, you can see why stocks go up and they tank after great news like Blue, BLUE is the symbol. We talked about that on the Kerry's show on Friday at the 3 o'clock Kerry's video call, and why the stock dropped 40% after getting FDA approval.
You're sitting across the table from, you're the retail investor, and then you got the institution. What is his perspective? What is his position on the market? What is he trying to do? And all he's trying to do is make a couple pennies per trade. So if you start thinking like them, then you start to see how they're viewing the market. And when you view their version of the market, you become, when do I get in? When do I get out? Coming in at 9:58 today on Apple, you would have bought there, boom, you would have had that right up, because you're thinking like them instead of, this is an investment and a long-term investment. That's not how they're playing. And they also realize they're not trying to get big percentage returns. They're just trying to get pennies. So
but they're dealing with millions of dollars when they buy in.
Hundreds of millions.
The retailer, right?
You're absolutely right. And all they're trying to do, and Mark says it all every week to me, the kiddies get in the pool and between 8:30 and 9 o'clock Central, and the big boys come in at 2 o'clock and they drain the water and they suck it away from the investor, retail.
Well, that's when they flip you upside down.
What's that?
When they flip you upside down.
Yeah, and they take your money.
Yeah.
And I think that's, if you think like them, like an institution, like your job is to report to your boss at 3:05 Central Time that you made money and it was pennies at each time, then you're going to start to see how they view the market. And so I don't know. I think that I just look at that mentality of those people, and that they're just trying to suck you in so they can take your money.
Their only reason for existence is to take away the retail person's money, because
Yeah,
fight- they're fighting against the other institutions who are doing the same thing. That's where the money
Yeah.
comes from.
Yeah.
Well,
But I
it's
think-
interesting from when I'm doing this, I do much better on the days that I'm at home and can look at these patterns. But on the days I leave at 8:15 to go to the barn and play with the horses,
You don't
you
trade
know.
those days.
pretty much
Yeah.
I'm learning that.
Yeah.
yeah.
You know, I
Yeah,
mean,
you
I
don't
think
do
there's a
that.
time to be in the game and a time not to be in the game. And feeling guilty or
That's-
having an OCD addictive personality like myself, you
Everybody
are like,
has
oh, I gotta get in this, I gotta get in this. But after you
well,
lose a
that's-
couple $100,000, you start to change your mindset.
That's
You learn,
that's the
you
hard,
learn
that's
to
the
lay
hardest
back.
that's the hardest part for me is to tell someone, there's nothing, I don't see anything that I'm going to put on the chart today, or anything on this, because if it's not there, it's not there. And I always say, let the market come to you. Don't force the market. And I kind of like the days when I don't have to do anything because it's like a vacation day, from trading. And because
I'm OCD, but I've got multiple things
I
I'm
feel bad.
OCD about.
I feel bad for Paul because these aren't vacation days. This is his vacation. He's having a good time.
Yeah. There's a wonderful book that I would highly recommend you all listen to, and it's called The Unknown Market Wizards. It's the recent book by I forget his name, but there's this Market Wizard series that's been going on for like 20 some years. But it's The Unknown Market Wizards, and it interviews unknown traders who average typically a 30% average return over the last 10 years. In some cases, their worst returns for a year. Jason Shapiro is one of them. His worst year has been 10% in the last 10% positive return in 10 years. And what you'll notice is there's a couple guys who trade futures, and there's a couple guys out of London, and the most trades they make in an entire year is 13 trades.
Wow.
They sit around waiting. And they have a niche that they do. And of course they measure the barometer of the atmosphere, like Mark jokes about me, but they have a niche and they know what kind of trade they're looking for, and they'll wait and they'll wait and they'll wait. One guy I'm referring to, his average return is over 300% annually. And he sits around.
I mean, that's
future contracts. But what it tells you is you don't always have to be in the game. And once you find your process and your system, follow it, study it, be religious about it. Looking at 1 minute charts of Apple of this week, of all the stocks that you traded this week, and looking for behavior patterns.
I agree with you. I totally agree with you. That's what I do.
That's why last week I went over, trades up until the end of November, and they average only 13 trades on the paper trade portfolio a month. That's one every other day, basically, on the swing trade.
Hell of a return too.
In closing, markets can be a great way to invest. The problem is 98% or more of the investors in the world have a perception of what markets should do versus what they end up doing. And if you can change your perspective, your perception on markets, and take the perspective of the enemy that you're trading or investing against, you will become wealthier faster by not losing money. And I think that is really the key, is changing your perception of what markets are, and realize markets aren't what you think they are. It's what the guy you're trading against, or the institution, or the economy that you're trading within decides markets should do. Thank you for joining me again. Please hit the like button and the subscribe button to our YouTube channel, but also go to bestofusinvestors.com and check out our platinum subscription model. We are teaching people how to invest in this market versus the buy and die approach. We are teaching you, the investor, both from a long-term trader or investor to a short-term trader, how to look at these markets and what perspective that you should be taking in market conditions, and how to profit from these situations. It's I mean, honestly, everybody who signs up eventually comes back and says, I learned so much and I'm a better investor and I've changed up my whole game and I've developed a trading plan or investment plan and I'm now making money. So I look forward to seeing you at Best of US Investors at our Platinum channel swing trading call on Friday at 11:30 a.m. if you become a subscriber. And then if you're even a Premium Plus member, you get access to the Premium Plus call with Kerry, which is at 3 o'clock Central on every Friday. So I look forward to seeing you there. Take care and have a great day.